Okay, hello students. This video clip is continued from the previous video clip covering these internal operating schedules and the balance sheet at the end of the year. And then we'll finish up how to create the cash flows of the firm for the 6 months period ended December 31st. So now we have the initial balance sheet and the income statement for a 6 months period ending December 31st. And then here internal the operating schedules to get this ending inventory. And then we got the year-end balance sheet. So the purpose of creating this cash flow statement is to show actual cash flow generated by the operating activities. It's more it's the most the important cash flows for the perspective of investors, and then also investing activities cash flows from financing activity. And then what is the ending cash balance should be the same as the beginning cash at ending cash of the year-end balance. And then we also get net cash build or net cash the burn rate, and then timed out of cash through this creation of a cash flow statement. Okay, the net income. The company generate net income 3,000, but this 3,000 cannot be the same as the actual cash operation, because the cash is not actual all the sales revenue if the company use the accrual basis. For example, accounts receivable, accounts payable, accrued expenses, those are the information of the accruers. That is not actual like a cash transaction, but we create the net income from this transaction. Inventories purchase is not included in this net income, right? And then property, plant, and equipment also. Net income includes depreciation. That means that net income decreased by depreciation, which is non-cash transaction. That's why we need to add back this depreciation. So net income is always the starting point when we create the cash flow statement. 3,000, that is a starting point to reconcile. And then add back the depreciation. Here, depreciation expense, right? I'm gonna hide these lines so that we can go back and forth very quickly. And the increase in receivable, again, if the asset up, that means cash it down. The accounts receivable up, that means accrual based the revenue increased, that has not collected the cash yet, but we recognize the revenue that will increase, that increased in net income. That's why if the accounts receivable has been increased, right? So it has been increased. So I'm gonna put minus, or just you can make minus. We are showing the actual cash, the transaction, actual cash direction, right? So accounts receivable increased, that means, right, the cash down. Increase in the inventory from 10,000 to 26,000. So when the company increase their inventory in operation, but the net income on the income statement doesn't include any inventory, the purchase information here, right? That's why when the company increase asset, that means cash down, right? Again, the cash flow statement, it shows all the cash in and out, right, in the cash basis transaction, right? That's why the net income using the accrual basis must be reconciled with this cash transaction, cash direction. Increase in the payable, right? The payable increase, that means liability up, right? That means the company doesn't have to pay cash, right? That means cash up in the company, right? So the increase in payable from 15,000, right? From 10,000 to 15,000. So that is a cash in, cash up. Increase in the accrued expenses, also liability up. Because again, the accrued expenses, accrued accounts payable, that means the company recognize expense, right? Even though it is a non-cash, the cash transaction. That means net income decreased by this accrued basis expenses. That's why we need to add back or increase. So increase in accrued expenses can be calculated. Okay, like positive. So let's just sum those up. Then 54,000 is net cash flow from operating activities. Oh, really? Because the reason why I was shocked is that the net income was 3,000, but actual net cash from operating activities is negative 54,000. Yes, the company run out of cash. If the company wouldn't collect the cash, this receivables, that's huge amount, 50,000, right? So 50,000, this accounts receivable should be collected in a near term. That's why they need cash right away at the end of the year, the fiscal year end, 25,000. Increase in gross, the gross equipment. So there's no, right? No increase. No increase. So just 0. There's no the investing activities through this the 6-month activity. And the increase in a line of credit, right? So when the founder used the credit card line of credit, and then this $25,000 now that gets in the company, and then $25,000 is positive, right? Because okay, more specifically, there's no line of credit. Oh, oops, sorry. There's no line of credit. Where is the line of credit? Increase in line of credit, right? Exactly, the company borrowed money. And then net cash flow from generated for the period is just sum of all the cash flows from operating, investing, and right, the financing. So 25,000 is net cash that generated for the period, which is negative, right? So the company used for the period. The beginning cash, how much was the beginning cash? Now, where do you get this beginning cash? There you go, beginning cash, when the company start. So the ending cash amount must be 1,000 here, 1,000, right? The same. Now, semi-annual net cash build or burn. So how do we calculate this, the net cash build? Right, the operating activities plus, right, investing activities. So 54,000. And then monthly cash build or burn. So we have the $54,000 cash burn for 6 months, right? That is serious problem. And then 54,000 divided by 6. Every month, this company used $9,000. That is the cash burn rate. Cash burn rate. So time to out of cash. So time to out of cash. How to get this? The months. So we have only 1,000, right? We have only 1,000. And then every month, right? Then here monthly cash 9,000, right? I'm gonna remove the minus so that we can get the actual length of a month. Okay, only the 0.11 because every month the company uses 9,000, right? But the cash amount at most the company has 1,000. That's why in the previous the exercise in the video clip I emphasized on this accounts receivable $50,000 must be collected in a near term without a doubt to get this cash amount, and then it's no longer burned out this cash monthly basis $9,000. So it is necessary. Okay, and then this financial statement should be providing to the investors every monthly basis. Very important financial information. Okay, see you guys in the next video clip. Bye bye.